Hey everyone! Welcome to this series of the Beginner's Guide on how to invest. Through this series, we'll be teaching you key terms and things that you need to know before you start investing your money. So this first episode is going to be talking about return on investment, or ROI, and it's the return on what you get. So it's basically understanding the profitability of how much that you get in return for investing your money. So there's a calculation for this, which is usually the profitability over the cost of investment. And it's just so then you can decide whether it was a good choice, a bad choice, or if you could make a better choice in how to gauge where you put your money. So I'll just give a quick example here. So you have an investment of $100, right? And after say a week's period or a month's period, you got 120 back. So you sold your investment and now you have $120, but then you don't know how profitable it was. Well, first we have up the top, we'll have $120 minus your initial cost, which was $100, over $100. And this will come out to 20 over 100. And we have that as a percentage, so you times it by 100% and you get 20%. That's your ROI. So that's the return on your money. But first we have to understand what opportunity cost is. And opportunity cost is a theory about how resources are scarce. And in reference to investing, this is to do with time and money. And it's the idea that if you have one thing in one place, you can't have it in another place, right? So I'll give you a quick example. All right, so if you have $2 to spend on a bar of chocolate, right, you have to make a choice between, you definitely want the crunchy, but it's that you have to make a decision because you don't have unlimited amount of money. You only had that $2 to buy one bar because all the bars are the same price. And so with investing, it's to do with like your money. What a good ROI is compared to something else, let's select the most secure and safe investment, which is putting money into a savings account, which has the lowest reward because it's the most secure. Because when investing, it's based on a system of risk versus reward. So the higher risk, the higher reward, the lower the risk, the lower reward. So in Australia, the big four banks saving interest, which is basically the return that you get from leaving your money with the bank, has a base rate of around 0.01% for ANZ, with an ongoing rate up to 0.4%. So in clearer terms, if you had $10,000, after 12 months, you'd have $10,040. Well, you think this might be a good amount, but in retrospect, it's actually quite small in relation to inflation, which we'll talk about a bit soon. But look here at the highest savings account. So the highest that you can get with ING on the Saving Maximizer for 2021 was about 1.35%. So on $10,000 after 12 months, you'd have $10,136. So now what I was saying earlier was the reason that this is quite small is due to a concept called inflation. This is the amount that your money has in relation to purchasing power. So for an example, if you had $100, right, and the inflation is about 3%, right, so something costs $100, the following year, that same product, right, would cost $103. Yeah, so that's a $3 increase. And that's just because of how things move, and it's just economics. There's no other way to kind of explain it. It's just with the increase in supply of money and a whole bunch of other factors, right? So inflation on this same period, so $10,000 after 12 months, right, at a 3% inflation rate would be $300. So leaving your money with the bank, you made $136. But your purchasing power just decreased by $300. So you're in a... Now that we saw the rate that banks give, let's have a look at the stock market. And in order to gauge the stock market, most people use the S&P 500. You might hear this term, it's an ETF. I'll have another video on that later. And it's basically just a group of stocks, which is accrues for the market. So as you can see here that on the 7th of December, you had $3,691.96. If you left it in there for the whole year, on the 3rd of December, the same year, you'd have $4,538.43. As you can see here, it's done for you. It was a 22.93% increase. And this is drastically better than leaving your money in a bank. So what you were getting before was about 1.35%. Here is 22.93. And this is what you understand with ROI. So as you can see that it's the opportunity cost of leaving your money in a bank, which is more secure. What else you have to understand when it comes to ROI is that different investments and different risks and different sectors and all these things have different results. So when you're looking at things that you might see about hustlers and that sort of people, that they flip toys or they flip things at garage sales, that has a high ROI. But the downside to that is that there is limitations. Turning a $2 sticker or toy to $4 might have a high ROI opposed to leaving your money in the S&P 500, right? It might have a higher ROI, but it's not sustainable due to you can only buy one thing, that you could only spend that $2. And if you have $1,000, spending $2 to get that massive ROI is not doing anything for the other $998. So that's what you have to have a look at when people just say their ROI. It's also relative to the amount of capital or the amount of money, and also what industry or what sort of investment that there it is.